This is Jordan. This video is being recorded on the afternoon of Monday, July 31st, 2023. Thank you so much for tuning in today. In this video, I'm going to follow up on a point that I and Vince Lanci were making in the interview that we recorded on Friday. So I don't intend for this to be a long video because I just have one chart here, but I basically want to talk about inflation cycles and when the market peaks and the impact of interest rates. Because Vince made the point, eventually if interest rates keep moving higher, interest rates win out over the market, and that causes a decline in the stock market. And it reminded me of a point that I heard Luis Yamada making, that when the 10-year yield started to get above 5%, in the mid to late 60s, that's what basically stopped the market, from continuing to move higher. And so I just wanted to outline that and, make a couple points. And we know that history rhymes. It's not going to repeat exactly. I mean, I love looking at history, and I do think things will repeat in some way where we will have even more future inflation. The rate of inflation is going to recover and move higher in the coming years. But I don't want to say it's going to be an exact duplicate of what happened in the 60s and 70s. But, to illustrate the point here with a chart, so we have the CPI inflation here, and this is when the CPI had its first breakout. I mean, it looks like it was 65. So 65, it kind of had like a mini breakout here over this level. So 65, 66, it was 7-8 year breakout. But then eventually the big breakout was really in 68 when it broke above this high. And so I'm highlighting this here. This was kind of the first wave. Well, it wasn't kind of, it was 65 to 70. And so the stock market kept moving higher. I mean, it didn't, the secular peak wasn't until the very end of November 68. And that's when it, that bear market, it really broke below. I mean, this is the equivalent of the 40-month moving average. That's my demarcation line. So this is when it really lost it. Now, sure, I mean, it traded below it, a little bit here, a little bit here, a little bit here, but it wasn't that significant. I mean, this was the full-blown break of it right here. And, of course, the Dow peaked in 66. So, and this could be similar to what's going on now where, the Dow peaked in 66 and it did not make a new high here like the S&P did. So you had this decline here. I think it was around 24%, and then you had a recovery which wasn't all that great. And so I think we could possibly repeat that. But getting back to the rest of the chart, if you look at the 10-year yield, the 10-year yield had this peak in 1920. So remember, the inflation peaks were 1920, 1951, and then, I mean, you can see here, there was a CPI in 47, but 51 was when commodity prices peaked. So, and of course, the 10-year yield, this doesn't have the data, but of course, the 10-year yield, they had that fixed, I think, until I want to say they had it fixed from, they pegged it, I think, at like 2.5 or maybe 2%. From, I want to say 42 to like 1950 maybe, or maybe it was 42 to 51 or 42 to 49. But anyway, my point is, the before these years and decades, the peak in the 10-year was in 1920, and it was around 5%, 5.5%, something like that. So here, so 65, the inflation's breaking out, and you get this move up in the 10-year yield. Then in 66, you get this move down. But really, it was 67 when this move started here, and it went to, above 5.5%, got towards close to 6%. This was breaking above the 1920 high in inflation. And if you go back and look at historical charts on inflation, the 10-year yield. So if you look at historical charts of the 10-year yield, basically, you have to go to the Civil War. You have to go to the mid-1860s or so to find a point that was higher than 1920. So here it breaks above the 1920 high in the 10-year yield. And so this is basically, I mean, it broke above 100-year resistance. So here, this is the highest that it was basically since the Civil War time. So this was like a new 100-year high. That, and again, breaking above the 1920 high. So that was, I mean, that was extremely significant. And I guess considering that happened, not a surprise that, you know, the market would peak soon after. And so, I mean, looking here, so, you know, the 10-year in the mid-60s around 4%. Then it started to move higher up to 5 and above 5. So that's, I mean, obviously it's, you know, master of the obvious, but, you know, big difference between 4%, 5.5%. I mean, I guess my point is when you move from like 1.5 to 3%, it seems like a huge move, but it's really not. I mean, it's not, in history shows, it's not until you really get to that 5% level that it really starts to impact stocks. And of course, the Fed funds is at 5%. The 10-year yield now hasn't broken above 4% yet, but circling back to Vince's point and what Luis Yamada said in that podcast, you know, the 10-year yield, the bond yields kept moving higher, and that's the point when it really started to hit the stock market. And so this was this was before the market peaked, before the end of the first wave. But for the most part, you know, you had inflation here, 1-2%. You know, the market peaks. I think, you know, I should have put the prices on here. The market peaks, you know, in the 4s just before the end of that first wave. But that's another point, is that, you know, with the first wave of inflation, the stock market, for the most part, it went up with it. I mean, sure, the gains were slowing, but it went up with it. And it wasn't until, so here's the second wave of inflation. I mean, this decline was caused by, you know, inflation, and you had the Fed hiking aggressively like they're doing now. But, you know, the 50% decline here, that was with the second wave of inflation. Now, the third wave of inflation, the market started to go down. It goes down 20%. And then when inflation gets hold, I mean, you could say at this point, we've had inflation for, you know, a decade, more than a decade. So, you know, companies by that point, they're at least better equipped, or they've made some adjustments, so they're not going to get killed as much as they would have, you know, 5 or 10 years earlier. But anyway, so you had a 20% decline. And then with inflation really taking off, you know, it was a thing where I'm just looking for assets. I'm looking to buy assets. So the market kind of held up okay at that point. I mean, obviously you wanted to be in gold and silver and nothing else at this point, but that's the point. The second wave of inflation was when the market really got killed. And so, you know, we're not at that point yet. Obviously, we're, you know, basically at the end of the first wave. And you know, if we see in the next, you know, 6 or 9 months before a recession potentially, if we see commodity prices are rebounding again, led by oil, you know, the Fed's done hiking, and the 10-year yield breaks above 4% and runs, you know, that could potentially be the point. Then you get the market peak, then you get the recession. So that, I mean, that's one scenario. So I don't mean to babble on here forever, but just to summarize the key points, the stock market went up with the first wave of inflation. It got killed in the second wave of inflation. And in addition to that, the 10-year yield, at some point, that is going to cause stocks to fall. And we're not there yet because it's still, you know, in the very high 3s. But if it breaks above 4 and it goes up to 4.5 or, you know, 4.7, there's so much more debt, there's so much more leverage now that, you know, maybe it's the 10-year yield just going above 4%. Maybe that is what will cause the market to peak. Maybe that's the level, you know, at this point in history, since there's so much more debt. So just a couple things to think about on this Monday as I babble on here. Let me know what you think in the comments. And thanks so much for tuning in. I'll talk to you guys again in the next video.